Let's talk about a company you probably use every day, Leggett and Platt. Founded in 1883, they're not a flashy tech startup, but a diversified manufacturer. That means they make all sorts of components that go into products you use, like the springs in your mattress or the foam in your sofa. They're a major player in bedding, but their reach goes far beyond the bedroom. Leggett and Platt also makes parts for automotive seating, aerospace components, and furniture. Even the underlay beneath your carpet or industrial fabrics could be theirs. Their business model is all about diversification. If one area slows, another might pick up. This helps them weather economic ups and downs. They supply essential components, not luxury items, so other manufacturers rely on them. That's a solid foundation for any business. But even strong foundations can face challenges. Before investing, it's crucial to understand what a company actually does. Leggett and Platt's products are everywhere, but their name is rarely on the label. They're the behind-the-scenes force in many industries. Their wide range of products means they touch many parts of our lives. But is that enough to make them a great investment? As we dig deeper, keep in mind, diversification is a strength, but it's not a guarantee. Let's see what's really going on under the surface. Ready to dive in? Here's the big question. Can Leggett and Platt stock hit $1,000 per share? As of June 2025, it's trading at about $8.71. That's an 11,480% increase, an astronomical leap. For context, that would make Leggett and Platt worth over $134 billion, rivaling the world's industrial giants. Such growth is almost unheard of for a mature company. It would require a total transformation, not just a good year or two. We're not just talking about a price jump. We're talking about a company becoming a global powerhouse. Is this a dream, a possibility, or pure fantasy? To answer that, we need to look at the facts, both good and bad. Let's dig in. Let's look at Leggett and Platt's strengths. Their biggest asset, diversification. They operate in bedding, automotive, aerospace, furniture, flooring, and textiles. This cushions them if one market slows down. They're also restructuring, streamlining operations and cutting costs. By 2025, they expect to add $60 million in annual operating profit. Their global reach is impressive. Over 100 manufacturing facilities worldwide with 84 in the US. No single customer accounts for more than 6% of revenue, reducing risk. Some analysts think the stock is undervalued, trading well below its estimated intrinsic value. If their turnaround plan works, there could be significant upside. Bargain hunters see potential here. But potential is just that, potential. Execution is everything. Let's see what stands in their way. Now the challenges. Sales are falling, down 7% in Q1 2025, with bedding down 13%. This isn't a new trend. Revenue dropped over 7% in 2024 too. High debt is a major issue, $1.9 billion, nearly matching their market cap. That limits flexibility and eats into profits. They recently slashed their dividend by 89%, losing their dividend king status. That's a blow to investor confidence and signals cash flow concerns. Profitability is weak, with a net loss of over $511 million in 2024. Competition is fierce from both nimble private firms and larger players. Weak demand in bedding and furniture markets adds pressure. High debt, shrinking sales, and lost dividends are serious red flags. Turning this around won't be easy. The road ahead is steep. Can they overcome these headwinds? Leggett and Platt faces tough competition. Key rivals include Ethan Allen, MillerKnoll, Mohawk Industries, and Steelcase. Ethan Allen is strong in premium furniture but smaller and less diversified. MillerKnoll dominates office furniture but is tied to commercial real estate trends. Mohawk focuses on flooring and textiles with less exposure to automotive. Steelcase is big in office furniture but not in bedding or automotive. Leggett's broad reach is a strength, but high debt and sales declines are weaknesses. Competitors with healthier finances have an edge. Understanding the competition is crucial for investors. Where does Leggett and Platt truly stand? Let's talk numbers. In Q1 2025, sales dropped 7% to $1.02 billion. Adjusted earnings per share beat forecasts, but profit margins fell to 5.8%. They're aiming for 6.8% margins by year-end, banking on restructuring. Debt reduction is a top priority. They're selling non-core assets to pay down $1.9 billion in debt. Leggett and Platt went public in 1967 and was a strong performer for decades. Long-term investors enjoyed big gains and rising dividends until the 2024 dividend cut. The last 3 years have been rough. The stock is down 26% and nearly 50% over 5 years. That's much worse than the S&P 500. Volatility and uncertainty are high. Past success doesn't guarantee future returns. The financial picture is mixed at best. Can they regain their former strength? What's the long-term plan? By 2030, they aim to finish restructuring, boost profits by $70 million, and use asset sales to cut debt. They want to expand in automotive seat systems and infrastructure components. By 2040, the focus shifts to automation, smart manufacturing, and sustainable materials. Tapping into eco-friendly trends could open new markets. By 2050, they hope to lead in advanced composite materials and expand in Asia and Europe. These are bold goals, but challenges remain. Success depends on recovering demand, managing debt, and fending off competition. Global disruptions could derail even the best plans. The vision is ambitious, but the path is uncertain. Can they deliver? So, can Leggett and Platt hit $1,000 per share by 2030? Virtually impossible. The growth required is off the charts. Even by 2040 or 2050, it's a massive long shot. It would take a total transformation, slashing debt, reigniting sales, expanding margins, and inventing breakthrough products. The company would need to dominate multiple global markets for decades. Instead of chasing a $1,000 dream, focus on the real issues. Can they execute their restructuring plan? Can they stabilize sales and reduce debt? Can they restore profitability and rebuild investor trust? A healthy, growing company is the first goal. $1,000 per share? Don't bet on it. The real story is whether they can turn things around, starting now.